we'd like to say hello to everybody.
Good morning, Houston.
Especially our friends that have joined us from mid-Michigan and throughout the country. And a big happy hello to the Houston audience. Mark and I were down there a couple of years ago to meet with you in person. And today we'll try to do it by guessing what your reaction is to our speech. We're going to be talking about better investing, what we do and how we do it, and maybe trying to reassure some clubs about how they're working through things in these very difficult markets right now. And let's start by doing a standard disclaimer, if Mark will give me a click. And I just want to remind everybody that while we will be talking about specific stocks today, they're only for illustrative purposes. This is an educational demonstration, and we're not recommending that you buy or sell any of the stocks that we're referring to. We also might hold some of these stocks in our portfolio, and in the heat of the moment, we might forget to disclose the fact that we actually hold a few of these stocks. Standard disclaimer done. Let's get moving to the first slide. Well, we do have a shameless commercial. We're going to join you all in Houston on September 13th, 14th, 15th, and 16th at the Marriott West Chase. We'd love to see all of you there. If you can't come for all 4 days of the National Convention, really pretty seriously consider coming for one of the days. If you'd like a pure education day, come on Friday all day. The day rate is not very expensive, and you'll get a whole list of classes that you'll be able to choose from. Everything that our convention attendees take, you'll be able to take a look at. If you'd like to visit with corporate sponsors, Saturday's a great day to visit the convention. That would be absolutely free, and all you have to do is walk in and you'll be able to come to our expo hall and also listen to a couple of our panels and a couple of our speakers discuss some issues that involve investing. If you need more information, contact any of your chapter directors or go to the Better Investing website where you can register for the convention. Let's do another click, Mark. So folks, why did you come today? Why are you here? And if going through your mind right now are things like PE ratios and judgments on SSGs and returns on equity and debt levels, you know, all those things are important. Those are reasons why a lot of us come to educational events, but I'm hoping that most of you are here for a more base reason. I'm hoping most of you are here because you're just a tad greedy. And if you are just a tad greedy, then I hope you're here because you're investing for returns. You're keeping a focus on Section 5 on the Stock Selection Guide, and you're looking at the returns, the potential returns that a stock has going forward for the next 5 years. That's really the measure of how good your portfolio is. And I think we're going to spend a little bit of time focusing on measuring success and defining success as returns that beat the market. Mark, what do you think about that?
Well, first of all, again, good morning, Houston, and good morning, for that matter, America. One of my favorite reasons for being here today is it's one of my favorite things to do on Father's Day Eve. We did a program similar to this a year ago, and just want to make sure everybody realizes tomorrow's Father's Day and behave suitably. But what I think about all of this stuff is we are here to succeed. We're here to succeed individually, and we're here to help people around us that we care about also succeed. We're going to talk about some fairly specific measurements of success. And this graph kind of captures it all. This is what today's session is basically about. When we take a look at a group of investment club or better investing influenced portfolios, we find that on average, again, we've done a relatively small sample. We'll get into that in a minute, but on average, we're witnessing these levels of success that are superior to a bunch of institutional portfolios. We'll get more specific about it, but what we want to focus on for the next several minutes is Ken and I want to share with you a reminder of what it is that we do. I basically like to say we're not better investing. Better investing is what we do. We're actually a National Association of Investors, and but better investing is what we do, and we'll spend some time talking about how we do it. Specifically, we want to put those returns in context. As many of you know, one of my favorite books is The Wisdom of Crowds, shown there by Jim Surowiecki, and we really do believe in the wisdom of crowds, the wisdom of clubs, the benefits, the advantages of leaning on friends around us, especially a community of like-minded long-term investors. So we want to talk about what 70 years, literally 7 decades now, of this type of discipline and study and basically community just leaning on each other, what that is all about. How do we do it? What do we do? And we'll get specific about some that have done fairly well and lessons that we can learn. But again, as Ken said a few minutes ago, we really do believe that we are here for the returns, and higher returns are a whole lot more fun than lower returns, and certainly on a relative basis. Thought we'd share with you some of the more dramatic examples over the years. The Mutual Club of Detroit. I was a member of this club. As I understand, they've kind of waned a little bit over the last few years. Many of the founding gurus of the National Association have either passed away or are no longer involved. But over a period of 60 years, as shown by this slide, the Mutual Club of Detroit actually achieved an internal rate of return of approximately 14% during a 60-year period when the market went up 10%. So we basically always make that comparison between whatever we're studying, whatever we're benchmarking, versus some measure of the market, be it the Dow Jones Industrial Average, the S&P 500, the Wilshire 5000. In this case, this goes back so far that we had to actually blend and take a look at all three. But how is the club done versus what if we invested just generally in the market? And in this case, the Mutual Club of Detroit achieved a 3 to 4% return over a period of 60 years. A second club that many of you are very familiar with, the Beardstown Ladies, and I kind of love this example because, as many of you know, they caught all kinds of heat, all kinds of bad press. My nutshell version of the story is that Disney did not serve them very well. The editors at Disney, that's who wrote this book series for them, did not fact check properly, and basically they created a big problem for many people. But here's the story that you don't hear about the Beardstown Ladies. By the way, that's a Carnegie Library right from downtown Beardstown in the background there. But the period in question in the book and the subject of all the brouhaha a few years ago, they still managed to achieve a positive relative return versus the market. It wasn't the 23.4% actual return that was on the cover of the book. That was the heart of the rub. But what I find fascinating, because you won't see this written up in the popular media or in the financial press anywhere, this performance by the Beardstown Ladies actually outperformed 5 out of 6 active fund managers over that same period. And nobody talks about that. We'll share a third club with you here this morning. This one happens to be a group of ladies who joined us for our Dashboard Diagnostic series. We do a monthly series where we take a look at actual club portfolios. This is a group of ladies from Northern Virginia, and they've been around since 2008. And kind of the moral of the story here is, again, context matters. Keeping things in the right perspective matters, because this club, they had achieved a 4.5% return that you see right here. This 4.5% return over the period from 2008 through early 2012, and they were depressed, and frankly, they were ready to disband and give up when we pointed out to them during the session that the market, which we were measuring ourselves against, was actually down a percentage point during that time frame. So they literally were outperforming the market over their lifetime by 5%. That's massive. And in fact, their one-year relative return at the time was plus 14. So they are clearly firing on most of the cylinders, if not all of their cylinders. And again, we just want to make the point that keeping these things in context is extremely important. And they were more successful than they even realized. If they continue to do that over the long term, and especially if that propagates into their individual portfolios, they'll be very, very happy over the long term. Let's continue to put some of this stuff in a little bit of context. We talk about relative return. Again, relative return is the difference between whatever we're measuring, whether it's club performance or individual portfolio performance, versus some type of a market benchmark. 90% of the time we probably use the S&P 500 or the Wilshire 5000. But we want to put the number relative return into a little bit of context here. I think pretty much everybody here is familiar with Peter Lynch, One Up on Wall Street, great book, highly recommend it. Peter Lynch achieved as a manager of the Fidelity Magellan Mutual Fund between 1977 and 1990, basically a 13 or 14 year span, a 13.4 advantage to the market. By the way, he set out to achieve a plus 3%. That was his target. I'd say he's an overachiever. But that's what you see here basically graphed. Again, 13 or 14 years, and then achieving a 13 or 14% return. That's one of the best in the history of investing. Another person that we track, pay some attention to, as do many investors, especially long-term growth and value-minded investors, Warren Buffett. That's him right here. This is Warren. And from the period 1992, and by the way, this is characterized by many in the financial press as his cold spell. He's actually fallen into a slump. He's still operating at plus 6.6% advantage to the market over a 20-year period. If you go back and look at him over 40 or 50 years, it actually gets dramatically higher than that. So he has been in a little bit of a slump, but this is the type of slump I think most of us can handle. Then one last piece of context before we look at the bigger picture. I want to talk a little bit about this study recently done by Dalbar. These guys are performance management or measurement specialists in the investment arena, and they basically took a look at a group, a very large group of quote-unquote average investors for that 20-year period, and they found that during that period, the average investor had underperformed, that's what is shown right here, underperformed a general stock market benchmark by, just call it minus 5% per year. So again, during a period when the stock market, that 20-year period where the stock market may have advanced 8%, the actual average investor is achieving only 3%. And how do they do that? By doing some of the things that we, the people gathered here today, the not so average investors, things we don't do. We don't chase performance. We don't go out there and buy last year's hot stock or hot fund. So when you chase performance and basically don't build expectations to guide your investing efforts, that's how you end up at that minus 5%. We think, in fact, we know we're better than that. Okay, this one's a little bit busy, but what it is literally taking a group of club influenced portfolios, and those are the ones shown by the blue dots, and basically splashing them up, again, over a 20 or 30-year period, various levels of existence in here, versus a bunch of institutional portfolios, the ones shown in red. Notice how many red ones are showing up on the lower half of this screen. And again, here's the chart. This is basically the portfolios that built the chart on the lower right. As Ken cautioned me, everybody's probably looking at this one. We're going to talk about that one in a few minutes after Ken spends some time talking very specifically about a few of the clubs on this journey. But basically what I want you to keep in mind is just notice the number of blue dots, dark blue dots, that basically are hanging out in the top half of this screen. This 5%, by the way, is our magic objective. We're trying to end up somewhere around that dotted line of a 5% advantage over the long term. Again, when the better investing community talks about 15% goals over the long term, they're basically talking about markets which operate at 10% over the long term and then trying to achieve 15% returns over those equally long terms. One of the other things that I want to caution everybody about is the red dots here are actually biased up. And what I mean by that, when we started actually plopping the red dots on the chart, we started with the very widely held mutual funds and the funds that have been most successful. So literally, if I throw another 100 red dots up here, just choosing them at random, most of them are going to end up down here. Just know that for a fact. Most of them are going to end up down there. So again, let's get a little bit more specific. Ken's going to share some of personal experience about who specifically are some of these blue dots.
Well, I know that I'm talking to a group of investors that are basically club-based, and I'm going to be focusing on this relative return number. And I don't care what accounting system you use, whether it's the accounting system from iClub or the accounting system from Bivio, and I know that 99% of our clubs use one or the other. I'd like you at the next meeting to ask your treasurer to run that report very quickly about benchmarking what exactly you've been doing. Those benchmark reports can be run in a manner of 15 seconds or less, and once that report comes out, it compares what you've done as a club since, and you can change the date of the beginning of the report, but I like to run it from inception. You can run that report to compare it to what would have happened if you would have taken exactly the same money, made the same withdrawals and deposits into an index fund representing the Standard & Poor's 500 or the Wilshire 5000. Run that report, find out what your relative return is, and then if it's not where you'd like it to be, set a vow to change some operational things in your club so that you can begin to boost your long-term performance. I'm looking at some of the clubs that I belong to because all three of them that I belong to happen to be at on this graph above the 5% line. They've moved down just a little bit in the market that we've had recently, but they still have wonderful relative returns. I belong to Brighton, to Mid-Michigan, and to the Wolves Club. And some of these other clubs and red dots that we're looking at up here are clubs that we've featured on our dashboard diagnostics programs from Manifest Investing. We're going to talk a little bit about that portfolio called Tin Cup up there at the top in just a while. It's doing extremely well, but we'll talk about that separately. But if Mark will give me a click, we'd like to talk about the rules to success. How do you measure success? And basically, from our point of view, it's a 1, 2, 3-step process. Another click there, Mark. Let's start with this particular portfolio. This is the BI Brighton portfolio. BI Brighton is a model club in Brighton, Michigan. It's sponsored by the Mid-Michigan chapter and the Southeastern Michigan chapter. And here's the holdings in that club as of last night. You'll notice that some of the holdings in the club have 0 shares attached to them. And those are the stocks that we currently have on our Pounce list, stocks that we've vetted through an industry study process and that we would like to buy, providing the return moves into the place where we think it's going to add to our portfolio. Along the very bottom of the dashboard, because that's what we call this chart, along the bottom of the dashboard are some totals. And those totals help us set targets for when we know that the dashboard is healthy and when we know it needs a little bit of boosting. I like to keep the return on a dashboard in a club that I belong to at 5 points above the market average. And the market average as of last night was about 9.5%. So that means that the sweet spot, 5 points above, is somewhere between 14.5 and 19.5. This green number of 16.8 is a wonderful par going forward. These are weighted averages, so it takes into account the fact that Apple represents 20% of the portfolio and that Aflac represents almost 11%. A real high-quality portfolio, great earnings stability at 70 plus, wonderful financial strength at almost 90 out of 100, and excellent growth, 12.7% sales growth. That should be enough to maintain the forward momentum of this portfolio. I'm putting this out here for you to take a look at, and when you grab our slides from the websites that we're going to post these on, you'll be able to copy these holdings down if they're of any interest to you. Brighton has achieved a 5.5% relative return, and that represents about a 17% return since its inception. That's an annual return since its inception almost exactly 5 years ago. The next club is an older club. This club is almost 9 years old. It's achieved about a 3.1% relative return, and in numerical terms, that's a little bit better than a 10% annualized return over the time period we're talking about. And again, you can see the holdings if you wish. You can see that when this club meets this coming Monday, one of the things that they'll be talking about is the need to boost just a little bit their total return. They're looking to stay in the sweet spot, which is 5 points ahead of the market. The market's at about 9.5. They'd like to be at about 14.5, and they'll be looking at the bottom stock return-wise in the portfolio. That's National Research, NRCI, and they'll be asking themselves whether it would pay to trade that stock in for something with a higher return. Notice they have Deckers on their pounce list with a huge potential return. They also have MWI Veterinary Supply with a pretty decent return, and doing a trade one for the other might boost the return into the spot that they're looking. Here's the third club that I'm involved in. Click again, Mark. Thank you. This is the Wolves. This is a 20-year-old club with an almost 5% relative return. That translates into just a little bit better than 10% annualized for the last 20 years. And again, if you look at the numbers at the bottom of the dashboard, you'll notice that everything seems to be lined up really pretty decently. It's in the sweet spot for return. We have great quality. We're at 80% plus for earning stability and for financial strength. And we have a sales rate of 12.4%, which should be fast enough to really guarantee that this portfolio continues to operate at a relative return that will beat the market. Mark, I think that that's my ending slide. Let's look and see. Absolutely. So I'm going to turn it back to you to describe exactly what we're talking about here on the Manifest 40.
Well, I gave that last portfolio a gold star for long-term performance and also being in position for going forward. This is the one that we talked about just a few minutes ago, is the one that was a little bit slightly different colored a few slides ago. And why this is so important is it really does come to the concept or the notion of leaning on each other. Because this is a list that we compile and we put out quarterly of the 40 most widely followed stocks by the subscribers at Manifest Investing. And many of you here in attendance today are subscribers. So this is the top half of the Manifest 40. And again, we'd just like to keep track of them. We keep track of all the things that we do around here. And this one has been around between 5 and 6 years, 6.5 years, excuse me, and has achieved a return of an internal rate of return or annualized rate of return of 7.4%. And that is at almost 5% relative return, positive 4.9% relative return. And frankly, that's how we know that most of you are doing okay. We track this. These are, because they're the most widely followed, it just follows from that they're probably the most widely held or among the most widely held. And as Ken was saying when he was looking at this list earlier this morning, I think most of us in the room would be well served to have a half dozen or so of these within our portfolios and treat many of these as core holdings within either individual or group or club portfolios. So good stuff. Again, we track this and very pleased to see it at a positive 4.9% relative return. I want to talk about another portfolio that's very club influenced, very better investing influenced. It's our model portfolio known as Tin Cup. And we just had kind of a magic moment here a couple of months ago. By the way, it's gone from this $1 million moment during the May correction, or I'm not even sure what to call May, other than a month to forget. It's actually gone from $1 million down to about $925,000. What is the portfolio? It's basically starting a portfolio back in 1994, 1995, and investing the maximum amount into a 401k, and then pretending that you could invest in stocks all along that time frame. So again, maximum amount into an individual 401k with the capability of buying stocks. Well, what stocks? The stocks that show up at the top of our screening efforts based on return forecasts quality, financial strength, all the stuff we're about to speak about as being important. And we'll kind of put this one up here just as a reminder that this portfolio stays fully invested at all times. It's always stocked up with a number of core holdings, but as we know, it's not going to be immune to what happens during bear markets. Now, it went down a little less than the bear market. It's actually come out of the bear market with flying colors and done quite well over the last 5 years. But this is the actual portfolio that we talk about, the decisions made in our monthly e-newsletter every month, describe the transactions that are actually taking place, and literally dig into the portfolio on a monthly basis and share every single transaction. One of the other reasons that we like to share this one is, again, we're going to be talking more about this guy named Walter Slosh. He was one of the top performing red dots on the right-hand side of that graph a few minutes ago. And one of the things I really like to point out is that he was a money manager managing millions, if not billions of dollars. And just kind of take this in, that over 39 years of investing, he achieved exorbitant returns. Check out these numbers. And he used principally value line. And what makes that important is these words right here. He's just like any one of us. He literally never left that office. He used value line. He did fundamental analysis. And he practiced investing in a way that any ordinary investor can, and that's important. So that's what this portfolio does. We kind of think of this as a Walter Slosh memorial type portfolio. And again, we look forward to our $2 million moment not too many years down the road. But I mean, just think about that. 17 years investing the maximum per month into a 401k program and having $1 million literally in 16 or 17 years. I think there's a fairly powerful story there. Let's kind of backtrack here and talk about, for a couple of minutes, how do we actually do this? And I'm going to break down our time-honored guidelines into and change the words and paraphrase a little bit, because I think this kind of captures the elements of what we do most important. I'm going to start at the bottom. This is something Ken talks about all the time. When we talk about the gurus or the founding fathers or they're very influential people over those 70 years of investing at Better Investing, one of the most powerful things that they give us is discipline and patience, and basically study the stock, build expectations, and that all comes down. It manifests in all three of these. But what I think is probably the most important word we're going to talk about in a second, this notion of imagining. Imagine, a very powerful concept. Ken's going to spend some time reinforcing why it is so critically important to try to invest in the best. I mean, there are all kinds of flavors of investment opportunities out there, and it is possible to speculate and invest in a company like Research in Motion hoping for a dramatic turnaround. That sort of stuff does happen. But in general, when you're talking about core holdings and the type of stocks that most dramatically capture our attention or routinely capture our attention, investing in the best is a very important concept. And then Ken's going to talk about being prudent with portfolio design and management, especially this notion of appropriate diversification and focusing in on basically how we build out our portfolios. So I'll start with this one. Some of you have seen this before, but it really does bear repeating. The guy on the left is obviously Warren Buffett with his feet up. His company does own, by the way, Berkshire Hathaway, approximately 10% of the Coca-Cola company that they decided to buy one day back in the late 1980s. And the reason that we bring it up here is when we talk about our stock study method, sometimes the stock selection guide makes people a little bit dizzy or their eyes crossed or glazed over. And what I like to reinforce with all of them, especially the people that are relative beginners, is it really is no more different than the stock study process encouraged by Mr. Buffett, where he puts his feet up, he closes his eyes, he literally takes a deep breath. In many cases, he takes a sip of cherry Coke, and then if he's thinking about investing or buying a company, he literally stops and tries to think about what will this company look like 5, maybe 10 years from now. In other words, what does the business model look like? And that's what we refer to when we talk about business model-based analysis, top lines and bottom lines. And yes, we love up, straight, and parallel. Whatever company that is, pretty good characteristics. But again, this notion of closing our eyes, really trying to build an image or imagine what that company might look like 5 years ago, that's not dramatically different from, in fact, it's the same thing that Mr. Buffett does and that all of the investors within this community also do. One of the other ways we like to characterize this is, again, sometimes people's eyes glaze over. Now, I like to point out that, in my opinion, a stock selection guide is not a piece of paper. It's not a piece of software. It's a process. It's a process that reinforces very powerful milestones. As we go through the study of any company, what we're really trying to nail down are three very key assumptions about what that company might, how it might go forward. What does the track record look like? That's important. But also, where does this company seem to be headed? And we want to form very carefully considered perceptions or opinions about how will this company grow going forward. Again, based on that track record and where they seem to be trying to go. So we want to develop a sales growth forecast and come up with the answer in the first blank here. So that's number one. How will this company grow? What does the outlook look like? How profitable will they be? What will their percent margins be? How profitable will they be? That's the second major consideration that we have to come up with. And then the third and final one that basically builds out the entire forecast. Again, as Ken suggested a few minutes ago, the bottom line of any stock study is the projected returns in Section 5. And this last fill in the blank is a very important function. You know, what is a reasonable price-to-earnings ratio for that company over the long-term time horizon? So we want to basically build out those three major milestones and build your forecasts. This is literally what it looks like on paper. The one difference that we do at Manifest Investing versus some of the more traditional studies is we do embed a couple years of analyst estimates. So we're always watching for how the analyst estimates will either affect the long-term trend either in a positive way or in a negative way. We're always watching for inflections or influence or impact on these trends, the top line sales and the bottom line earnings. Again, watching for any type of opportunities or threats to, you know, what is happening to this long-term trend. And the projected annual return is our favorite flavor of forecast for any company that we follow. I'll turn it over to Ken for reinforcing why quality matters so much.
Thanks, Mark. Mark has done a lot of work over the years, a lot of research into some of the original tenets of the Better Investing organization, and I clammed onto his work quite a while ago. I found it extremely interesting, and I really have devoted the last 10 years or so of my teaching life to promulgating some of these ideas. We've talked about quality a lot, and actually George Nicholson and to a lesser extent some of his teachers actually had a definition of quality. What Mark has tried to do in Manifest Investing is to attach a number to that quality, and it's based on four basic concepts. First of all, it's based on financial strength. What's the quality of the balance sheet? What does the cash flow look like? How much debt does the company have incurred? All of these things make up a balance sheet, and a rating for financial strength is the first pillar, if you were, of a good solid quality rating. We then move to earnings stability, and that would be the second pillar. And earnings stability is a measure of how straight is that line on a stock selection guide. The straighter the line, the more earnings stability points a stock would achieve. Since we're working on a scale of 1 to 100, since we have 4 different categories, each category is worth 25 points. So a perfectly straight earnings line would give us a 25 points. Most companies don't achieve that kind of a earnings stability score, but I think you get the idea of how it's accomplished. We then move to compare the company we're talking about against its peer group, against its industry group. And we look at two things. First of all, what's the profitability of the company that we're looking at compared to the peer group? The wider the positive variance, the more points you'd get in quality for relative profitability. If the margins, the net profit margins on company A are 10%, and if the industry's profit margins are 5%, then that's a pretty decent advantage for our company over the industry as a whole, and that should reflect in the quality rating. The last pillar of the quality rating is relative growth, and we're looking at how fast the sales for our company are growing, and again, we'll be comparing those to the sales of the industry or the peer group that the company happens to be in. We do this over a period of time. We collect the analysis from many, many different opinions, different sources, and we combine it into a quality rating. 65 or greater means you have an excellent quality company. 55 to 65 is good, and the scale moves down from there. Mark, if you can give me a click. And the reason we do this is that when we start to look at high-quality companies and low-quality companies, we find real differences. Here's some of the lowest quality companies back in the bear market of 2000 to 2001. Looking in the database during that time period, we see some of the lowest quality companies, and some of these are very familiar to you. And we note that many of these very low quality companies during this bear market in 2000-2001 performed significantly to the downside. Now, a low quality doesn't guarantee that you're going to perform to the downside. Notice that Guitar Center or Toro Company both performed reasonably well during the small recession in 2000-2001. But as a rule of thumb, the lower quality companies tend to perform more poorly in a bear market. If you could click again, Mark. Here we are 1 year into that same bear market, however, and now we're looking at 10 of the highest quality companies in that same sample. The slide before was the 10 lowest quality companies. This slide are the 10 highest quality companies. And you see a distinct difference. In average, the higher quality companies tend to perform fairly well during a minor bear market like we had in 2000-2001. Again, however, a high quality is not a guarantee that you're going to perform to the plus side. Notice that in this time period, McDonald's and Microsoft actually grew smaller, actually declined rather than move to the upside. Let's click one more time. Here we are in the Great Recession from March 2007 to March 2009, and again we're looking at the lowest quality companies. I don't know, there's about 15 of them there, I guess. And notice that the lowest quality companies are significantly underperforming the market. In fact, on average, the lowest quality companies lost 60% of their value during this 2-year time period. We click once more, and here we are looking at the 10 highest quality companies during that same exact time period. Now, we still see a lot of red ink. We still see a lot of negative growth because this was the Great Recession. This was a time when virtually nobody escaped losses. But when we compare the losses from the low-quality companies to the losses from the high-quality companies, we notice that the averages are different. The low-quality companies average nearly 60% losses, while the high-quality companies are averaging about 19% losses. They did better than the total market, which averaged losses of around 27%. And notice in this high-quality group, we actually have some companies that beat the market, that did better than the market, even during this significant downturn in fortunes for most stocks. One more click, if you would. We like to look at an industry because the quality is partially based on relative returns within the industry, and we like to point out that if you take an industry, here's the orthopedic medical supply industry, for example, if you take that industry And if you sort it by quality, you have a ready-made industry study ready to go for your club or for you as an individual. I'm looking at a good 8 or 10 companies right here, but frankly, if I were studying the orthopedic medical supplies as an industry, I would confine myself to at most the first 5 stocks on the list. Maybe I would even confine myself to Stryker, Zimmer, and Smith & Nephew, although Surmodics and Exactech have good quality, but I don't think I'd pay much attention at all if I'm building a growth portfolio. I don't think I'd pay much attention at all to the stocks near the bottom of this list. The quality matters, and by focusing on high-quality stocks, I can improve the performance of my portfolio, and that's the reason that we're all doing this in the first place. I want to point out that I visit probably 35 to 40 investment clubs every year, both in Michigan and throughout the country, and I want to point out that most of our better investing investment clubs understand quality. And when I look at their holdings, I find that they're almost uniformly loaded with high-quality companies. Clubs have issues, there's no doubt in my mind, but one of those issues is not understanding quality. I'm looking here at diversification because diversification is kind of the fraternal twin, in my mind, of quality. If you're going to keep the growth in your portfolio at a sufficient rate to keep that portfolio moving forward, you're going to have to diversify. You're going to have small companies as well as medium-sized and larger companies. Mr. Nicholson suggested that large companies will only grow on average at about 5 to 7%, while small companies should grow in excess of 12%. Well, think about it, folks. If you're loading your portfolio up with just large companies, you've pretty well confined the growth of your portfolio to a 5 to 7%. And if the market's growing at 10, which it does on average, then you're telling yourself that you're going to be satisfied with negative relative return. Look at that gold line on the graph. That's the S&P 500 over a fair period of time. Notice how flat it really was for an extremely long period of time. Notice that after about 10 years, it's just about at the same place it was when the graph begins. By the same token, however, compare that to the Russell 2000. That's a measure of much smaller companies, 2,000 of them, and notice that while there was virtually no growth in the S&P during this time, there was growth, in fact significant growth, in the Russell 2000. You can see the recession. You can see that both indexes took a pretty good dive during the recession, but you can also see that the Russell recovered much more quickly and went on to actually give some real return over that 10-year period. Let's click again. Basically what I'm talking about are all of my friends at CNBC here who have been telling you that you cannot do what we do. They're telling you that the individual investor cannot make any money in the stock market, and they're constantly talking about the lost decade. They're constantly telling you how your money's been dead for the last 10 or 12 years. Well, when I look at stock charts, just simple graphs of performance, and we'll click again. Bye, Maria. We'll click again. And we'll notice that if I compare an index that has small stocks, medium stocks, and large stocks in it, and that would be the value line arithmetic index. That's the green line. If I compare that to an index that contains mostly large stocks, that would be the S&P 500, I don't see a lost decade at all. I agree that if you were just keeping your money in the large 5 to 7% growing stocks, such as make up the S&P 500, I would agree your decade would have been dead money. But look at the growth in that same 10-year period for the value line arithmetic index. Again, the recession was there for all three indexes. Nobody escaped the recession, but look how the stocks came out of the recession. And the diversified portfolio, the one with small, medium, and large stocks, not only beat the portfolio which was essentially large stocks, but it also beat the portfolio which was essentially small stocks, the Russell 2000. An important blend or balance of great high-quality blue chip, slower growing stocks with faster growing, exciting small companies that meet the same quality standards results in portfolios that give you return even over the times like we've had in the last 10 years or so. It's enough to convince me. I hope it's enough to convince you. One more click, Mark.
I just want to say that Maria is so 1990s. I've moved on to Kelly Evans. She's one of the new young ladies at CNBC.
I need you to get a picture of that Australian woman that's speaking on CNBC.
Yeah, we got to work on that. Yeah, apparently
got to get some new pictures there. Okay?
British accents are important, apparently. Well, let me
so
just
you're going to wind us up here? Okay, great.
Let me just kind of close this down with just reinforcing that. I think one of the major things that sets us apart from everybody else, those so-called average investors in the Dalbar research, is that we build expectations. We basically study our companies, come to know who they are, what they're trying to do, and we build these expectations in the, again, closing our eyes, taking a deep breath, and coming up with the results of a stock study, which includes a return forecast. Very important element. Again, as we go through and we study and understand our companies better, we want to develop credible, feasible expectations, things that are really achievable. Pay attention to the influence, powerful influence of economic cycles and recessions. All that stuff matters. But the return forecast is the bottom line result. Again, focus on section 5, pick your favorite flavor. Our favorite flavor is the projected annual return. But we think that that's a most important factor. And again, like Ken said a few minutes ago, most of you out there don't struggle with this notion of quality. You embrace quality, you get it. Even those of you who tinker a little bit with speculation, I'm guilty of this from time to time. But overall, you get the quality side. Keep working harder and harder and diligently on understanding the price to value concept of this return forecast thing. That is the area where you can avoid making some of the larger areas that you can make as an investor. So with that, what we thought we would do is spend a couple of minutes demonstrating some of these concepts with, we've got 10 or 15 minutes up to Ken and I for years have been putting on a session called Let's Talk Stocks. And by the way, one of the reasons we wanted to do this session today is to just let people experience a taste of the type of stuff that will go on at that Houston National Convention in September. And part of that is a session called Let's Talk Stocks. Ken and I have been doing this in chapter programs going back several years now, where we basically try to take all of these lessons and deliver them in the form of, what can we actually do to implement the stuff Ken and I have been talking about for the last few minutes. So what I'm going to do is jump out of the PowerPoint. That's okay with you, Ken?
Sure, Mark. And while we're doing that, we do have a couple of questions that we can maybe get taken care of.
Okay,
the first question is, are we going to post our slides anywhere where people will have access to them?
Well, first of all, we will post the PowerPoint session in on the Manifest forum. I'll go back to this when we close, but our email addresses are on the front slide, and then the Houston chapter directors also have copies of the presentation if you'd rather reach out to them. So that's where they can be.
And then the second question, Mark, is quality on a bell curve? And I can answer that one. Quality's not on a bell curve. In other words, there are not more average companies than there are excellent companies. Rather, quality's been divided up into quintiles. That's 5 different groups. And the top 20% have been labeled excellent. Remember, that would go from a quality rating of 65 up to 100. The bottom 25% are labeled as poor. That would go from a quality rating of 35 on down to 0. And then, of course, everything in between. But they're with quintiles rather than with a bell curve. So there are 5 relatively equal divisions, each one carrying their section. The neutral category actually contains 2 quintiles from a little bit above 50 to a little bit below 50.
Okay, any other questions or comments, Ken?
I think we're up to date, Mark, on everything else.
Okay, so let's go ahead and demonstrate again a stock search. I'm using Manifest Investing. I'm going to go in and I'm going to demonstrate one of my favorite stock searches. And what we're basically going to look at is we use a thing called the Manifest rank. And the rank is simply no more complicated than simply taking the 2 things that we talked about for the last half hour, the return forecast, and combining it with the quality rating to come up with a combination factor that we can hunt on. And what I like to do is go down to the Manifest rank and enter 99.4. Why 99.4? Well, that's going to basically give you the top percentile, the highest 15 or 16 companies amongst the 2,500 that we follow. The way I remember this is Ivory Soap. Ivory Soap is 99.44% pure. Enter 99.4. You only have to enter one number. Hit search. And bam, you'll have a list of approximately 15 or 16 companies from top to bottom. Again, some of them are going to be perhaps a little bit dicey because the stock price has been perhaps slumping a little bit or whatever. But a fairly decent shopping list to go to work on from top to bottom, starting with Cognizant. That, again, has been depressed in stock price. That's what's driving it up, this list, to a number of opportunities. FOSL, I see, FLIR Systems, Cisco Systems, Buckle, Coach, another favorite. Solar Winds, a company out of either Tulsa or Oklahoma City, just up the road, that quite an effective software consulting type company. So there's a bunch of opportunities there for potential sale. What I'd like to share with you here, just in a nutshell, is how do we boil that list down from time to time? And for the last several weeks, I've been paying attention to some anecdotal studies where I want to basically whittle this list down by setting aside the companies that are not in favor. The sentiment is weak behind them. I posted this in the Manifest forum. If you go into the forum and you click on stocks, I posted these screening results under what here is Stock Search Ivory. If you click on that Ivory Stock Search, and what I did is I went in and I basically went out to stockcharts.com and looked at the companies that have either negative or neutral sentiment. The ones color-coded in red here happen to be companies that have bearish sentiment. And what that means is that basically the Wall Street institutions and investors in general are kind of cool to the stocks. Now, long term, that could be fine. But for the next several weeks or days or whatever, for some period of time, they're not interesting. That's probably the best way to put it to the people who do the most trading. So the ones in red are the ones that have bearish sentiment. The ones that are in yellow are more neutral but still bearish. So in order to filter this list down into stocks that I would have interest in further studying, I've color-coded those, and I'll just ignore those at the time. So the top one that survives this screening effort is a company that I know very little about. The company is called Altisource Portfolio Solutions. You can see that it's got very good financial strength rating, pretty good stability of earnings, an excellent quality rating, that's almost top shelf, and a projected annual return somewhere in the high teens, if not 20%. Well, what I've done here at this post is actually included a link to a mini study, because again, I know nothing about this company. I know that It's a company that there's a professional fund manager by the name of Doug Cass has expressed a lot of interest in this company. And you can see here that I talk about Doug Cass. I don't know, he's kind of a hyperactive Chuck Allman, maybe a way to think of it. I'm always looking for very successful stock pickers. And in this case, Altisource is one of his favorites. Well, they provide stuff that has to do with subprime mortgages and various types of real estate, asset management, credit stuff, all kinds of stuff that makes most of us in the room go, ew. Anytime you go ew in the realm of investing, you could be dealing with something that people are afraid of or don't understand or whatever. Don't, in fact, let that be almost a catalyst or an incentive to study even harder. And in this case, as Ken likes to point out, there's actually an investor relations report presentation where you can go in and learn more about the company. This is straight from their website. Presentation that they recently made. Again, I have not had a chance to study it in any great detail, other than to let you know that there's stuff here that describes their business, and they do a lot of stuff that makes us go, ew.
I wonder, Mark, if this company would be a partial competitor to Portfolio PRAA, Portfolio Review.
I think they couldn't. In fact, they could be either a competitor or a supplier too, because they definitely make software-based and management consulting type solutions. So they could be either or, could be or both. Here's what they look like. Taking a look at a track record. Again, they have a fairly short track record, a couple years of public trading. They're headquartered in Belgium. They do have a pretty good pile of employees. And again, in terms of, you know, as I take a step back and I see the carnage going on in Europe, especially this weekend, along with what is happening in many of the financial markets, I don't think we're out of the woods yet. And so the field of opportunity for these guys could remain strong. You can see we have embedded a few analyst estimates into the picture here, and it's a compelling story. Probably not one that I would run out and buy, other than to monitor it fairly closely. And let me reemphasize the point here. The stock price actually has zoomed up into the high 60s, which is basically at all-time highs. What you're looking at here is a technical analysis report, a 3-year look at the company on stockcharts.com. One of the things we know is to generally avoid companies when they get a little bit pricey, the relative strength index up around 72. But this happens to be the type of company that is in a long-term bullish trend. They do seem to have a lot of market opportunity out there. What I'll probably do is add them to one of my watch lists or pounce piles and watch for an opportunity. As you can see, we had one just about 6 weeks ago where the stock price was down in the low 50s. And I'd probably be eager to watch for that type of opportunity to present itself again. So again,
Mark, you told us about a bullish sentiment and bearish sentiment. Can I read that directly off this chart, or is there another place I'd go to find that?
Excellent point. Let me go ahead and jump out to stock charts. Again, stock charts is completely free. If you enter the ticker symbol, you'll see the chart that I just displayed, although I've got mine set to 5 years, so you see a couple of missing years here. But here's that relatively high stock price. At the bottom of this chart, at the bottom of this page is what's called a point and figure chart. Just click on that. And you see here, this is the trend, a bullish trend that they think could be in an indeterminate amount of time. You heard what I said there, indeterminate, nobody knows. Price and figure charts are not about time frames. But they think that the longer-term trend for this company or shorter-term trend could be a stock price of 96. So again, it's in the mid-60s right now. And they basically see a bunch of institutional interest in the company that could drive it as high as 96. Now again, I don't get wrapped up in the stuff other than in the form of a tiebreaker. But Ken and I were kicking this around a few minutes this morning, and he's a real skeptic, and I understand that. So am I. But we also have this notion to believe that sometimes there's such a thing in the world of investing as kind of self-fulfilling prophecies. And they certainly provide pressure for situations. So I've been watching these situations over the last several weeks. I've been intrigued by the number of times that I've watched companies like FactSet Research, for example, drop into the mid-90s based on the type of projections that you see in places like this. Why is FactSet Research probably not the best idea no matter what the projected return is now? Notice that it says bearish here. and they're basically thinking that the price could relax as low as 74. So again, just some things for you to chew on and kick around, and we'll be spending more time on this subject at Manifest Investing going forward. But again, fairly compelling picture from where I sit. Very bullish tendencies at the present, and certainly one worth keeping tabs on, and certainly better understanding.
Good idea. It's a great stock to take a look at. It's one that's completely off my radar, Mark. Mark, can you go back to stock search, and I'll show the folks how I came up with my first choice here.
Okay.
I love to run the screen that I'm going to describe to you right now, because how many stocks appear on this screen gives me a real good idea of where the market is, as well as a lot of other things. So I start by peeking in the upper right-hand corner at what the actual par is for the whole database. And if you'll notice right now, my par is at 9.4%. I'd like to hit the sweet spot at 14.4. So I can either put yes right there, or I can type in 14.4 in that very first box in projected return right there. And in fact, Mark, I'd like to turn that dot off because I'd like to type in just the 14.4 and leave the top open, okay? I'm going to ask
very
for...
frisky. Very frisky.
Yes, I'm going to ask for high-quality stocks of 65 or better. I'm going to request a financial strength of at least 70. And then I'm going to jump down to earnings stability and request earnings stability of at least 70. And at this point, I'm going to hit the screen. I'm going to leave everything else blank, and I'm going to hit the screen. And what I do is I get a number of stocks, and what I love to do is come down to the dividing line, the place where I'm just at the very top of the sweet spot, maybe one or two stocks up into the sweet spot, and those 3 or 4 stocks right around that dividing line are really always very interesting to me. And today when I ran that screen, in fact, when I've been running this screen for the last 4 or 5 days, FOSL has been popping up on my screen. So I've been doing a little bit of research. If you listened to me on Ticker Talk last Wednesday, you heard me recommend FOSL. Since then, I've been doing a little bit of preliminary research, and I really like this company. I really like the concept. They're calling themselves, at least their retail people are calling themselves the poor man's Coach. They do a lot of the same kinds of goods as Coach does, but they're at a much different price point. And, you know, I just love these as soon as we get FOSL up here. Here it comes. And I just love it when I can say up, straight, and parallel. And, you know, they're not as straight as some have been, but they certainly didn't decline like many retail companies did during the Great Recession, and they've certainly bounced back really nicely since that point. I think FOSL's a very, very interesting company to take a look at. Could you turn this? No, you couldn't. Let's just leave it at that, Mark. I love the concept. I love the idea, and there is a wonderful presentation about the company on the investors website. Go to the FOSL website, look under Investor Relations, and there's a wonderful presentation there. Want me to do another one, Mark? Or?
Yeah, go ahead. I was just going to, for kicks, go and take a look at what Value Line says. And this is a case where Value Line, in my opinion, is overly pessimistic. So anybody who's looking for times when Value Line is pessimistic rather than optimistic, I think this is one of them. It's a worthy study. Notice that
I think also, Mark, if you scroll down, you'll see that this is a fairly old Value Line. And I would, and I would expect the price has changed. It's different from the top of this Value Line, and all in all, I don't know whether these numbers are as up to date right now as they could be because of the price change and how old the data happens to be. I'll give you another idea if you could bring up another SSG for us, and it's GNTX. GNTX.
You want the SSG, Ken?
If you could, yeah. And you know that Mark and I are both from Michigan, and Michigan is doing much better than we were doing during the Great Depression, the Great Recession, thank you. But we still love to recommend Michigan companies when we find companies that we think are worthwhile of mention. I know that Gentex is in the auto industry, and for some of you that might mean stay away. We know that the industry is highly cyclical, and that causes issues with trying to define what's going to be happening. But all of that being said, I really think that Gentex is best of breed in the auto suppliers. This is where I think the best money is to be made if you're going to be investing in auto stocks at all, auto manufacturing or supply stocks at all. I like the fact that Gentex, which makes high-tech mirrors, they make up some of the backup systems that the government is thinking about requiring on various kinds of cars, a lot of high-tech gear to go inside the car, inside the cockpit, if you will. And I like the fact that Gentex sells to the entire auto industry itself. They don't just confine their sales to Ford, GM, and Chrysler. They sell to the whole auto industry. So if you're looking for an auto share, and I get the question quite a bit, you know, Ken, you live in Michigan, how about an auto stock? Well, here's an auto stock that I think bears some further study. Take a look at it. It's done fairly well over all of its history, and even during the Great Recession, Gentex was able to maintain a much better decline rate, dare I say that. It didn't decline nearly as much as a lot of the other auto suppliers, and again we get that pattern of bounce back after the recession that I really like to see. It's an interesting stock. I would recommend it for further study. If you're looking for something in the auto industry, a reminder once again, this is a highly cyclical stock, and you have to be prepared for that cyclical nature. GNTX, Gentex.
And a technology company too. And in fact, in the spirit of full disclosure, my wife and father own some of this company, and our son actually worked in the factory out in western Michigan couple of summers ago making very fancy rearview mirrors for Mercedes-Benz. So we know a little bit up close and personal about the company, but again, it's been a long-term community favorite.
I think you'll see it in some of the portfolios of the clubs that I belong to as well, Mark.
Yeah, I think so too. I'm going to go ahead and close up with one last visit back to the forum place that I was at. I'm going to go to stocks. I'm going to go back to that Ivory search that I had, and because this one is one that we've had a whole lot of fun with here recently, and it showed up on Ken's results just a minute ago also, not too far down the list. Oh, by the way, FOSL has dropped from that $125 or $130 a share down to $70. That's why the value line page is not representative from a price perspective. And as is shown here, the actual institutional sentiment is bullish on the company now. Right after FOSL on that list, BioReference Labs. Many of you are very familiar with the company. It's a company that took us on a bit of a roller coaster back around Thanksgiving time. This is a company out of the New York area that is into basically lab work, analysis of body fluids and all that kind of stuff. And BRLI is the ticker. You can see it shows up near the top of this list. It's definitely worth studying. This is a company that I probably wouldn't take an oversized position in it, but boy, it's well positioned in a number of ways. It was the victim of some short selling towards the end of last year and some short squeezing that went on. I just want to point everybody to one quote here that I've been talking about here for the last couple of months. Something I learned from somebody, again, up straight and parallel. The stock price took quite a dive towards the end of last year. There you see the dive. But I want to go to an interesting little philosophic quote. There's a more recent up-to-date pretty up straight and parallel, kind of hard to justify that price action that we saw. But here's the quote, and it basically has to do with a Roman physician named Galen that talked about characterizing illnesses by the analysis of fluids over 2,000 years ago. And just kind of think about that. Many professionals in the medical field, including a couple of the members of John Kimmel out of Wichita's investment club, suggested that it's not necessarily the fancy MRI equipment that's going to get the attention of the investing community. It's going to be the simple solutions like fluid analysis, and companies like Quest Diagnostics and BioReference Labs are worth a closer look. So there's a little bit of philosophy and a theme for you to take away from today's session.
Mark, you're able to navigate Manifest as if you wrote it, but I guess you did, didn't you? But why don't you pull up BRLI just as a stock, because I'd like to leave them with an ooh-ah moment about the little magnifying glass.
Okay. And just go into the stock page for BioReference Labs.
For BRLI,
Then we probably better wrap and give the gavel back to the Houston crowd, I think, Ken.
Right, as soon as you can get to that page. And see this little magnifying glass there, folks? If you happen to be a Manifest Investing subscriber, I find that most of you have never really looked at that before, or if you have, you've just treated it as a graphic. Actually, if you click that magnifying glass, and Mark's just clicked it, you get a list of all the articles that reference BRLI. They're dated, they're listed in order. You also get a list of all the forum posts that mention BRLI. Again, they're dated and listed in order. And if you're researching a stock, I'll tell you, this is one powerful tool. That little magnifying glass appears next to the name of any stock that you access through the Stocks tab at the top of the page for Manifest. It's an ooh-ah moment for the people that I always show it to, and I hope it gives you something to take away and think about. I've really enjoyed myself, even though I've had no idea how we're going over, Mark. I hope we let you a few laughs and we taught you a few things. And Mark, as always, it's been a treat presenting with you. I always enjoy doing that.
Well, thanks. Likewise. And again, I put the cover slide back up, so if you want to request or if you have follow-up comments or questions, both of our email addresses are there, and you're certainly welcome to reach out to the folks in Houston also.
Ken or Mark, there was one question. You had the list, and there was an asterisk next to the company names. Could you tell us what that means?
Anytime a company has an asterisk at Manifest Investing, it simply means that the company is outside or external to the value line standard edition, outside the 1,700 companies. So that was true in the case of both Altisource and BioReference Labs. And I think we're done if you're ready to take it away, Arlene.